Okay, so we have a new chapter, chapter 12. So from this chapter, then the next we'll have the 13th chapter for binomial tree. Then we jump to the 18th chapter talking about the Greek letters. All of them it's kind of hard uh, to use slides. So I rather write down the detail in the whiteboard so you can take notes and uh, yeah, that's it. That's it. So yeah, and very luckily today we have three students assigned for the first group assignment, so I can save some energy by asking some questions. Well, from my own perspective, I really like this chapter the most. I remember that when I was an undergraduate, I liked those option trading strategies a lot. Although, unfortunately, I don't really practice that much, but I like this thing. And later I go to the master program. I remember that there is still a derivative class, a derivative course, and the professor is quite old gentleman, and come to this chapter. So he asked me to draw those payoff structure for him in the whiteboard. So and every time I draw one, right, he said, "Oh, good job, good job." I was so that the experience was quite nice for me. Okay, and so for us today, our job is to cover three parts of this chapter. So this chapter have four parts. Okay, basically combining strategy, combining options with different assets. Okay, we cover the three parts. Okay, we leave the same type of option base, which is a spread strategy, to the Thursday because here the spread strategy, later you will see that this Thursday you will see spread strategy is more complicated. Okay, so option strategy is interesting and can be very complicated because option is the only one that have a symmetric structure. So in one side your payoff is flat, in the other side your payoff is increasing depending on the direction of underlying assets price movement. So this is the only one that has such a variation. So, and combining options with other assets can give us a very interesting outcome as well. Okay, so the first part today we want to have is the so-called principal protecting nodes. This one is quite simple. Okay, basically from the name you can know the content already. It called principal protecting node means that your principal invested in the option will always be protected. Okay, a typical structure is like this. So you combine it with a cash vehicle. Typically we call it a bond. Okay, oh, well, just like I said before in the put call parity, you don't need to pay too much attention about the freezing here. It can be a bond, it can be your euro bond, it can be whatever you want. Okay, it can be corporate bond, can be say preferred stock even. Okay, if you can control the default risk, control the the payment schedule, right? So anyway, you want a cash vehicle that can generate enough cash for you at a relatively lower risk. Okay, and then the other part is an option. Okay, so this is the principal protected node structure. So let's use one example here. So I just randomly pick one stock. Okay, this morning. Because last time we pick Nvidia. So this time we change to another company. Okay, uh, we don't need to pay too much attention on the specific company. Okay, we are talking about a general strategy that can apply to any stocks. even any assets. Okay, if you want to apply it to crude oil futures, that's also okay. Okay, we can definitely develop the options for futures, right? So in this case, last night, Tesla stocks, let's scroll up. Okay, last night Tesla stock price stopped around 233, and over the after our market, it increased a lot. Now it's about 239.49. So let's take this, okay, as our reference, current stock price. Okay, and for our understanding, so I choose a specific maturity, which is the year end, okay, December. So the options where I will talk will all mature by December this year. It's a relatively long time, okay. From now on, you have about 9 months. Okay. So scroll down, you can check the call option and put option. So a common case for principal protecting node is to choose an at the money option, at the money call option. So at the money one, the closest to this is 240. So this one, yeah. So last price, bid and ask. Okay, so if we want to hold the call option, means we want to purchase it. So the exchange will ask us for with the ask price. That means what? Means this option will cost us 54.75. Okay. So with this case, let's have a very reasonable assumption. Okay, let's assume that initially we need to invest in the principal protecting node for with $1,000. Okay, then we allocate about 50 to options, one option contract. Not really one option contract, but just one share of the option. Okay. And the remaining parts, we still have more than 100. So we put all of them into the bond. Okay. So 1,000 minus this, 945.25. Okay. So the idea for principal protecting node is that we want to carefully choose the bond. So to make sure that at the minimum default risk, we can get the eventual cash outcome around this value. Okay. So this setting is that we want to make sure that the cash, despite the option part, the cash vehicle here we choose, no matter you choose it as a bond, your bond, whatever it is. Okay, we want to make sure this one can generate the same amount we initially invested. Okay, so this is the whole picture of principal protecting nodes. I think the idea here is quite easy, right? You're combining the cash combining with a call option. Okay, so well, it is there, and I want to talk about three aspects of this thing. So first aspect is about the trick in the designation. So designation and rationale, then some detail. Not really detail, but we can call it a variation. Okay. Okay. So first is about the designation. Here, actually, the design is quite careful. I would say this is quite careful, although the structure is simple. Okay. We have the bond structure here to make sure that you at least get paid with $1,000. So this is because, right? If if only you have taken the 4300 investment course, you will know that in behavioral finance we have one very prominent feature called the loss aversion. Okay, you three. What is loss aversion? All the writers not that loss aversion. Yes, exactly. Perfect. That's the one I want. Yes. Okay. So loss aversion here, referring to a phenomenon. Okay. I tend to talk about theoretical background a bit more. So in 1970s, there is one very prominent research outcome called the prospectus theory, which analyzed the mental accounting of different outcomes. So they draw a very famous graph like this. Okay, so this graph, the x-axis is your gain and lose. Okay, here is 0. That means on this side, on the left side, it's about your lose. On this side, it's about your gain. And the y-axis is the most interesting part. The y-axis is about your feeling. Okay, it should be done by Kahneman and Tversky. So their conclusion is like this. So you will have a graph like this way. Okay, so these two are not symmetric at all in any sense. So if here is $1, here is the same distance, here is a negative $1. So the gap here and the gap here referring to that actually people feel much more pain with a $1 loss comparing to $1 gain. Okay, this is the so-called loss aversion. So, well, once you find some behavioral finance bias, okay, behavioral bias is basically here. Okay, if you are the trader, you can trade against that in the market, right? Because if everyone else run with bias, but you run in the correct way, then the equilibrium will by the end bring you some benefit, right? But if you want to sell this principal protecting notes to some customer who have this loss aversion, right? So you will design it in accordance with this phenomenon. Okay, so your designation is that you will provide a certain outcome here. You will make sure that at least they will get their principal back. Okay? At least their annual return can be at least 0. Okay, so we actually have some similar concepts here, right? So we have some similar concept called the risk aversion. What is risk aversion? Hmm. Okay. Let me rephrase that. You are definitely correct. Let me rephrase that. Risk aversion means that if you fix the return the same for two assets, you tend to choose the one with less volatility, less risk. This is called risk aversion. If the outcome, the return for two assets are the same, you tend to choose the one with less uncertainty. Okay, so this is the risk aversion is actually the root of the high risk, high return principle. It is because everyone in the market they should be risk averse. Okay, just more or less. Some people they are more aversion than some people that are less averse. Okay, so although this is not a part I really want to emphasize, but well, as long as we are the most difficult course in finance, we are the end of your journey in this university, right? I want to kind of take a quick review here. So these two are, although they look the same, they looks like quite similar. They are referring to different concepts. Okay, they exist in totally different framework. Risk aversion is common, it's reasonable, it is the optimal, it is the nature of human beings. It's referring to people's preference on high risk, high return. Loss aversion, instead, it is referring to some irrational behavioral bias that treat the gain and lose differently. Okay. So good job. Good job. So here you can see that it's not a hard designation, but they make sure here your principle can be protected, can be fully refined. Okay, and after you learn finance, you can see that this is actually not something meaningful, at least from our perspective, right? Because once you learn finance, right, you know that the benchmark you always want to compare, okay, for all assets, it's not your principle, right? Your benchmark you compare should be the risk-free rate, right? Like if current US risk-free rate about 4.25% or 4.5%, then for you to compare your investment outcome with a benchmark, at least you need to compare it with the risk-free rate, right? Or you can even make the risk adjustment, okay, using the CAPM model, measure a risk bearing outcome, okay, which is referring to a higher return rate, and then comparing your portfolio with a certain risk bearing rate, right? This is how we measure the outcome correctly with correct benchmark. But well, normal citizens, right? Although the finance department is a large department in our university, but there are hundreds of different majors in the society, right? There are only a few people hold the undergraduate bachelor degree, and a few hold the finance major bachelor degree, right? So the majority of the public, they don't have the idea, right? What they can really think about the investment is whether I can get back my investment, whether I will lose from it. Okay, so just considering about their mental, we designed the principal protected notes. Okay, so designation is here. And when you try to brand it, okay, you can see that, okay, we offer you things like called Boben-Li-Cai, right? We offer a thing that with no risk to lose any of your principal, and you have a potential to earn more, okay, with some expectation there, but depending on how your option can work in the future. Right. Okay. So this is about designation. The trick is here. And also, in addition to that, the second point I want to raise is the rationale here. Okay, so because our course have a lot of content, we do not only talk the derivatives from the institutions perspective. We do not always talk it from the bank, like an investment company, hedge funds perspective, but we also want it to be useful for individuals. Okay, so if we move from the bank's perspective to an individual's perspective, then the question here is that why we should rely on banks to help us to construct these principal protected notes. This is so easy, right? Purchasing bond. I can do it with my security account as well. I open my mobile phone app. I purchase a bond. That's it. I can do it. Options. Well, I can I save enough amount and pass the test maybe, and also pass some requirement like you have 3 years trading activity in your security account. Then I can be qualified for option trading. Okay, and then after I can be qualified, I purchase option as well. Okay, I can do both by myself. So what's the point for us to rely on bank to form such a very simple strategy? Okay, so the rationale here is that the cost sometimes is too high for individuals. Okay, so first for options, when we're talking about the margin requirements, as well as the transaction costs, we say that options, if you trade in the market for just one contract or two contract, you will see that the fixed cost for one single transaction is actually quite high, several hundreds of dollars. Okay, and then you need to pay the transaction cost for the option. You sometimes, bid ask spread is also high. Okay, you can see that in this example, if you check the one we just use, the option with strike price 240, the last price, okay, according to the last successful transaction is 51.9. But the updated bid ask prices are 54.05 and 54.75. Okay, that means what? Means even if the last transaction last night is traded with a price about 51, but come to now, okay, even if the option market is not open right now, the updated bid ask prices are much higher than we expected. All of them are quite risky. Okay, especially when you're considering about an individual investor who do not really hold enough amount of cash. Okay, and that's actually why that not in China but in the U.S. when you want to be qualified as an option trader, you need to submit some certificates, like you need to prove that you at least have 10 million US dollar total asset. Okay, include your house, include any properties you hold, or you at least need to give them your pay slip, right, to show that you have a very nice monthly income, like several, uh, like maybe half a million something, right? That the requirement is quite high. Okay, because if you are just a very small investors, usually the option trading is not worthy for you. Okay, and the second, the problem for bonds is that yes, so bonds also have its transaction cost, and yes, it's sometimes very costly. So recently, I just purchased some Chinese government bond as well as U.S. government bond. So as I remember that when I purchased a bond, so there are at least three lines of fees. Okay, for